Hi everyone, I'm Humairaa Moola, the founder of HM Accounting. And over the past 15 years, I've worked with entrepreneurs, startups, and growing businesses across South Africa and abroad. So I've seen businesses with high profits collapse. And not because they weren't making money, but because they didn't understand their balance sheet. So if you've ever looked at your financials and thought, I know what's in my bank account, but what's all this other stuff on my balance sheet? Then this video is for you. We are going to unpack the balance sheet, what it is, what it tells you, how to use it, and why it's so important for your business strategy. We're also going to look at how to analyze it step by step. And I am going to give you a real client example that shows just how powerful it can be when you understand it. Let's go ahead and dive in. So, what is the balance sheet? The balance sheet is one of the three core financial statements alongside your income statement and your cash flow statement. But unlike the income statement, which covers a period of time, like for example, January to December, the balance sheet shows your financial position at a single moment in time. So it's built around a very simple formula, which is your assets equals your liabilities plus your equity. Now let's break that down further. Your assets are what the business owns, which is things like your cash and your bank balances, your accounts receivable, which is money owed to you, your inventory or your stock, your equipment, your vehicles or property, so your assets. Then we have our liabilities. So this is what the business owes. In here, we would have things like supplier accounts, which would fall under your creditors, bank loans, SARS liabilities or tax liabilities like VAT, PAYE, as well as income tax, credit card balances as well, and any long-term loans that you have with any banks or other institutions. And then we have equity. So the equity section will have what belongs to you, the owner, your capital contributions, and then the retained earnings, which are the profits that you have kept in the business and not drawn out. The name balance sheet comes from the fact that this equation must always balance. If it doesn't, then there is something wrong with your accounting or your bookkeeping system. So, why does the balance sheet matter? Now, many business owners focus only on their income and their expenses, but ignoring your balance sheet is like looking at your speedometer but not your fuel gauge. So, here's what your balance sheet can reveal. It can reveal your liquidity, which is can you pay your short term bills? Your solvency, which is your business financially stable in the long run? Your working capital, which is the cash that you have available to run your operations day to day? And your debt load, which is how much of your business is financed with loans or with creditors? And then your equity growth. So, are you actually building wealth from this business? It is also important for loan applications because banks look very closely at your balance sheet. Tax audits, SARS will check for accuracy and for compliance on your balance sheet. And investor funding, they want to see what is the business's net worth. And if you are serious about building a sustainable and a scalable business, the balance sheet is not optional and it isn't something that should be ignored. Now, how do you use the balance sheet strategically in your business? Here is how smart business owners use their balance sheet to make decisions. Number one is assess the financial health. So, what we are looking at here is that a business with more liabilities than assets might be over leveraged. A business with poor equity growth may not be reinvesting enough. Number two is manage cash flow. Large amounts in accounts receivables, you're waiting for payments, too much stock, your cash is sitting on shelves. Number three is budget for growth. If you want to expand, Your balance sheet tells you if you can afford it or if you need funding. Number four is monitor return on investment, which is your ROI. Your assets should be working for you. If they are not seeing returns, something may be underperforming. Think of your balance sheet as your financial mirror. It reflects not just what you've done, but what you should be doing next. So I'm going to give you a client example so that we can bring this whole thing to life. A local retailer came to us very frustrated. They were generating consistent monthly revenue of over 200,000 a month, yet they felt very cash strapped and couldn't pay suppliers on time. So here's what we found in their balance sheet. We found that their accounts receivable had, which was their debtors, had too many customers who were paying too late. We found that their inventory was overstocked with products that weren't selling fast enough. We found that their cash on hand was very low and their creditors had a significant amount as well. And then they had a loan repayment due as well that was quite high. So the issue that we gathered wasn't sales. It was that most of their assets were locked up in unpaid invoices and stock. We help them to introduce stricter payment terms, offer discounts for early payments, and reduce stock and switch to a more lean inventory practice. Within 3 months, their cash balance improved by 55%, and they started making supplier payments on time without needing a loan. So, how do you analyze your balance sheet? Let's walk through 5 steps to analyze your balance sheet like a pro. Step one is calculate your current ratio. The formula would be your current assets divided by your current liabilities. A ratio above 1.5 means you can pay your short-term bills. Obviously, anything below 1, that's going to be a warning sign. Step two is to review your debt to equity ratio formula. This is your total liabilities divided by your owner's equity. A ratio above 2 can mean you're too reliant on debt. And banks often use this when assessing loan applications. Step three is check your asset allocation. Break down your total assets. How much is cash? How much is stock? How much is stuck in unpaid invoices? This tells you if your money is accessible or if it's trapped. Step four is look for trends. Compare this month's balance sheet to the last 3 to 6 months. Is your equity growing? Are you accumulating more debt than value? Are your assets increasing in line with revenue? And step five is review retained earnings. This figure shows how much profit you've reinvested. If it's decreasing despite profits on your income statement, check for any hidden issues like very high dividends or any accounting errors. So let's recap. The balance sheet is not just for SARS or for your accountant. It is a very powerful decision-making tool that gives you visibility over your finances, clarity for growth, and protection from financial surprises. And when used correctly, it helps you run your business proactively, not just reactively. If you'd like to go over your own balance sheet or have us generate balance sheets for you and you have no idea where to start, we do offer one-on-one consultations. We also offer accounting and bookkeeping services to help you analyze your finances and develop a strategy that is tailored for your goals. Contact us at HM Accounting, www.hmaccounting.online. I will also put that link in the description box below. Do not forget to like, share, and subscribe if this helped you, and leave a comment with your questions so that we can create videos that serve you better. Until next time, I'm Humairaa, and I'll see you in the next video where we turn numbers into clarity, into confidence, and strategy.